The collateral damage that is really coming in from the US and European debt crisis, this has really shifted the front lines of the currency wars to Japan and also Switzerland. Now, Bank of Japan today eased monetary policy and sold 1 trillion yen, joining Switzerland in its effort to tame currencies buoyed by the safe haven demand.
The strong yen was tamed by Japanese authorities today, who intervened in the foreign exchange markets. The intervention was expected, but analysts were surprised that it was timed with the policy meet at the Bank of Japan. The yen was driven down just a day after the Swiss National Bank intervened to hold the franc. The two currencies have witnessed a phenomenal rise in the past few weeks as investors exited developed markets and abandoned the dollar for safer options like the franc and the yen.
There is very strong demand for safe haven currencies, so I think that's going to limit the scope for them to drive a sharp rise in dollar yen, and that's compounded by the flow backdrop. Though I do think that if there is repeated intervention from Japanese authorities, that they can introduce some more two-way risk into the market and probably stabilize the cross, close to where we are right now.
Analysts continue to believe that the G3 currencies are the best place to be and recommend investors position themselves in the euro, yen and even the US dollar.
I think looking across the market, broadly speaking, over the medium term, you should still look for the dollar, the euro, the yen, the G3 currencies to underperform the smaller currencies who remain much better positioned.
Emerging market countries such as Brazil and others in Asia are also seeing their currencies rise. Investors in search of high yields and economic growth are buying into these units, and investors speculate that the sharp jumps in the currency markets may prompt a globally coordinated intervention. Although the complex logistics, expense and limited chance of success make that unlikely. The intervention that works historically is G7 intervention. So is this a G7 issue?
It's not a G7 issue because it's a result of problems elsewhere. What are we going to do? The problem is that a weak currency doesn't cause inflation. So we all want weak currencies in order to stimulate growth, because we don't have growth.
For now, Tokyo needs the yen cap. Still reeling from the after effects of the March 11 disaster, a higher yen will hurt exporters, which in turn will bleed an economy, which for a large part relies on external trade. Venkatesh Rao, ET Now.